Hey everyone, welcome to our global energy market update, wrapping up the year of change. We're going to give everyone about maybe another minute or two before we get started, just to let some latecomers get into the room. So let's give it about another minute. All right, I think we're going to get started. Welcome again, anyone who just joined in the last 30 seconds to our global energy market update, wrapping up the year of change. One quick housekeeping item. We do look forward to your questions. So if you guys have any questions, on the right side of your screen, should be on the right, you'll see a space, looks like this, where you can enter questions, and we will go through them at the end. So, quick intro. What is HedgePoint? HedgePoint was started from a former OTC trading desk of ED&F Man. It was formed from a private equity buyout by Albright Capital and Kenta. We are a bilateral hedge counterparty with our own proprietary technology, including a cutting-edge position control portal inside our broader client portal. So in a nutshell, we provide market insight and knowledge, risk management solutions, and hedging execution. We are a 200-strong company with offices around the globe, including Latin America, North America, Europe, Dubai, and Singapore. We have very deep risk management and trading expertise across just about all commodities. We trade a number of currencies, and we cover the entire energy spectrum from oil products, natural gas, biofuels, and carbon initiatives. That's an important one, carbon initiatives, keep in the back of your head. We also have a very strong research team with specific analysts devoted to specific commodities, and those guys do a really good job of putting out some interesting content. So in terms of speakers today, there's going to be three of us. There's myself. I've been in the industry going on almost over 23 years now, actually. I started out in the late 90s as a market maker on the floor of the New York Mercantile Exchange. I traded oil product options, and then lived overseas. After about 8 years doing that, I lived overseas for the better part of a decade in Singapore and Switzerland in various sort of trading and risk management roles. We also have Austin Haggerty. He's a veteran of BP's Integrated Supply and Trading Group. And Austin joined the company, joined HedgePoint about 3 years ago. And then Mary Stavola. Mary has some very deep sales and trading experience coming from JP Morgan and Cargill before joining HedgePoint a little over a year ago, well over a year ago, actually. All right, so why don't we go to the next slide. I'm going to do a quick macro overview, then pass it off to my colleagues to talk about upstream, downstream refining, and then sum everything up. So first slide here. All right, COVID-19 world situation is improving. I think there's two interesting graphs right here. You can see how new cases have sort of tapered off and flatlined, and same, more importantly, the orange line, new deaths. The chart on the right is interesting and not really all that surprising when you look at it, because you can see COVID stringency index per country. Stringency refers to the relative tightness of restrictions, and not surprisingly, China's restrictions are a lot higher relative to the rest of the world. The interesting thing, though, is if you look across the graph from left to right, you see that their restrictions have not really changed, while everyone else's were lower, higher, and then back down again. So So let's talk about China a little bit. You can't really talk about COVID really without talking about China, and you can't talk about energy without talking about China. So China is the biggest crude oil importer in the world. And in terms of just looking at OPEC numbers, at the beginning of the year, Chinese oil demand was expected to be around 15.17 million barrels per day for the year for 2022. Looking back before that, oil consumption grew by about 130,000 barrels per day from 2019 to 2020, and then about 1 million barrels per day from 2020 to 2021. However, this year we saw the first contraction in over 20 years in terms of Chinese crude demand. So demand through September of this year has been about 100,000 barrels per day lower than the prior year, about 14.86 million barrels per day versus about 14.97. There are some big improvements penciled in for next year. So we're expected to sort of resume the trend next year, jumping up to around 15.4 million barrels per day. So in short, what does this mean for crude imports into China with hopefully restrictions and stringency dropping? So, imports at the start of the year were a little less than 11 million barrels per day in China. First 9 months of the year, the imports of crude oil averaged less than 10 million barrels per day. So all in all, it was about a 4% drop year on year. And we've seen some improvement lately. October imports were a little over 10 million barrels per day. In November was a big jump to just under 11.4 million barrels per day, which was the highest for the year. So I think this is emblematic of particularly COVID here, that there's plenty of upside in this market that only really seems to want to go in one direction lately, which is down. So I'd be a little careful as we continue to plumb these lows. All right, the next slide. Let's see. Commodity prices buoyed. Commodity prices supported by relative supply shortage. So the chart on the left shows commodity prices, how they basically rallied into and through recessions in the past 40 years that have been caused by supply shocks, which is a little surprising. And the second graph, the graph on the right, shows commodity inventories and how low those inventories generally are. Look at it, aluminum and US grains and crude oil, everything very far below the 5-year averages. So you can't really look at inventories, I guess, without looking at supply chains and without talking about supply chains. And there's really a lot of questions ahead in terms of supply chains, because supply chains that have existed for decades are being just upended everywhere you look. So what COVID has revealed is systemic weaknesses in the way manufacturing itself is organized. So on top of that, the latest employment numbers in the US are extraordinary for this time, for this point in the cycle. You have a US economy that's very strong, you have demand for labor that's very strong, and we are nowhere near establishing a softness in the economy that's going to deliver a deceleration to the base inflation rate. So what else? You have geopolitical norms in general out the window. You have huge shifts. You have generational shifts that we're seeing in energy. You have global energy markets that are built on natural gas supply going between Russia and Europe. You have oil and natural gas movements between Middle East and Asia. And these sort of adjustments are ongoing. You're going to have more confrontation. You're going to have more volatility. So you can't have Russia blowing up its customer base in Europe. The German industrial model is broken. You can't have the Saudis slashing supply despite vocal opposition from the US. And you can't have the US draining crude stockpiles to levels last seen since the early 80s. You can't have all of those generational shifts without having more confrontation and more volatility. This is something that's going to take more than a couple months to adjust to. This is going to be ongoing and could potentially be getting worse. So next slide, I think tasiography and the Fed. So tasiography is the reading of tea leaves. It's trying to discern a message that may or may not be there. The Fed itself seems very far away from ending its interest rate hike cycle, or as we would all love someday to be lowering it at some point. The chart on the left shows the past 40 years. Every time inflation surpassed 5% in the US, it has never come down without the Fed funds surpassing the CPI levels. That would be the orange line in that graph going to zero, not surpassing the blue line, but simply going to zero, because the orange line is the Fed funds minus the CPI. So the result of that, obviously, is the cost of financing or simply adding production becomes much more expensive. Inflation versus the Fed funds rate is not usually this wide, as you can see on the right of that, the graph on the left. So what's going to give? Are we going to have higher rates, or are we going to have lower inflation? So in a nutshell, what this graph is telling us is that the Fed funds rate needs to climb higher, or theoretically, I guess the orange line could approach or break zero without the Fed doing anything more. But in order for that to happen, we would need economic activity and inflation to drop. And unfortunately, inflation seems to be pretty sticky at this point, so that doesn't seem to be likely. So I think we're going to continue, as the Fed in particular has made clear, with rates higher for longer than many people generally expect. So what worries me in this aspect is the danger of central banks tightening monetary policy to curb inflation in a context of very high debt and high property prices. So the question is then, what are the spillovers? What are the unknown unknowns going forward? And the slide on the right shows, no surprise, rising interest rates become a constraint on CapEx decisions. So put another way, when financial conditions are relatively elevated, credit becomes expensive, and then commodity CapEx declines. So the expected path forward, you can see a couple little arrows on the far right of that graph, that if financial conditions ease, then CapEx can be expected to recover. Or if we continue the way we are now, then you're going to see smaller capacity additions in the foreseeable future. And that in itself is a big problem, because if we have global oil demand at, say, 102 million barrels per day in 2030, like the IEA thinks we will, which is up from about 95 million barrels per day last year in 2021, just to fill that 7 million barrel per day gap at a 2% annual decline rate, we're going to need another 25 million barrels per day of new production by 2030. So we need to get to work on CapEx in order to meet that. Next slide, Austin. So despite a hawkish Fed environment, the labor market remains tight. It certainly does. So we're talking about inflation here. And when we talk about inflation, we're talking about easing. When is easing going to come? And what do we look at in terms of easing? We're talking about, is headline price growth subsiding? And what do we mean by headline price growth? We're talking about factory gate prices. We're talking about commodity prices. We're talking about shipping rates. We're talking about general inflation expectations. These are all early indicators. So from there, we also look at price pressures on global supply chains. Is that easing? Not really. If yes, though, then you have less pressure ahead on household finances. You have less pressure ahead on business activity. So that then puts less pressure on central banks. So there's a lot of big ifs, though, particularly in food and energy, which have been declining. Although for food, I would say it's less declining than it is moderating, unfortunately. Food prices globally are still at far higher levels than before the pandemic, especially at the household level. So the problem with food is that food production isn't always elastic, and unfortunately, it certainly hasn't been in this case. So the old saying, the cure for high prices is high prices, hasn't really applied in this case, unfortunately. Questions also remain in terms of the price cap on Russian crude exports. We've had a good 3 days, I think, since it's been initiated. The world hasn't collapsed yet, but we tilt the wrong way, and you're going to see headline inflation in places like the UK and the Eurozone skyrocket, and certainly not ease like everyone is expecting. And core inflation in that part of the world is already close to 5%. So scary stuff. Overall, inflation pressures remain strong and widespread. So we are still a long way from the 2% target by central banks. And we need to remember where this all originated. You have an energy price shock caused by a war in Ukraine, which followed on negative shocks to supply and positive shocks to demand triggered by COVID. So you have this combination of supply and demand shocks, plus big reductions in real wages, plus losses in, this is very important, losses in national income in net energy importing countries. And all of that makes the job of central banks hugely difficult. Next slide, please. I think this is the last one in the macro update. Funds are sitting on the sidelines, could have room to add. In other words, all this slide is really telling you is that there's a lot of managed money sitting on the sidelines. So we are coming into a new year, and there could be a reestablishment of positions, adding length and pushing markets higher. That's another reason, if you're worried about energy prices going higher, to be cautious right now with markets the way how fast they've come off so quickly. The chart on the right is the notional amount of speculative length in the US dollar. We've seen the US dollar weaken a bit from highs lately. Chart on the left is how many millions of contracts of spec net length is long in the commodity index there. So that, I think, wraps up, well, I guess the final point is that there's a lot of potential upside here. that wraps up the macro update. I look forward to answering your guys' questions later on. I'm going to pass it now to Mary to do some upstream.
Thank you, Jonathan. I'm going to start off by talking about OPEC. There we go. Historically, OPEC has been the world's marginal crude producer, but that has not been the case for a number of years. They've had a lack of investment, natural declines, sanctioned members, and all of this has led to lower crude production to the point where OPEC is now underproducing versus its own monthly targets. You can see this if you follow the graph on the left-hand side. The numbers have been negative since February 21. So what that is showing us is that OPEC has consistently been underproducing versus their targets since then. So when OPEC makes announcements of cuts, we have to consider the real production cut versus the headline number, which is exactly what happened in October when they announced a 2 million barrel cut, but the real cut was actually closer to 800,000 barrels versus their real output and not the 2 million barrel announcement. But they did at the time still cut their actual production when the market is tight and additional barrels are needed. So this goes to show their commitment to elevated prices. Something else that I want to note is that OPEC doesn't have much spare capacity, so they can't produce much more even if they wanted to, which is what the graph on the right is showing. As you can see, only a handful of OPEC members, such as Saudi Arabia and the UAE, have spare capacity, and we don't think that OPEC will be able to fill the gap of future oil supply loss due to their issues of lack of investment and natural declines, as well as sanctioned members. Now, moving on from OPEC, in the next slide, we're going to cover U.S. production. U.S. oil output has remained stable and has actually increased over the past couple of years, but there is a spare capacity issue which we're closely monitoring, especially with what Jonathan said, that oil demand could increase by 30 million barrels a day in the next 10 years. If you look at the chart on the left, it compares Permian oil output to the number of drilled but uncompleted wells. The orange line shows crude output steadily increasing. However, the number of drilled but uncompleted wells has reached a 4-year low, and that is the purple line. So what this is telling us is that producers have been converting these DUCs to operating wells, but have not invested in new drilling. The lack of investment can be attributed to a focus on lower CapEx and ESG, but the current high interest rate environment can also disincentivize investment. If you look at the chart on the right, you can see how much of an increase in oil rigs we saw during the low interest rate environment of 2010 to 2016. And we know that oil prices certainly had a lot to do with this increase in investment, but we think that the low interest rates contributed as well. And with the current high interest rate environment, we're not sure we're going to see the same level of investment as we've seen in the past, even though oil prices remain relatively high. So this is why we're watching the number of new DUCs closely to see if U.S. spare capacity will increase in the next year. Now let's move on to the next slide, where we're going to cover inventory and the SPR. The U.S. doesn't have much spare inventory, and Austin will cover this in more detail later on, but what I want to highlight is the SPR, which is the Strategic Petroleum Reserve, which is the government's emergency stockpile of petroleum and can be thought of as the supplier of last resort. The government released almost 200 million barrels this year to try to lower prices domestically, but the irony is that the majority of these barrels were actually exported. And we've had draws in U.S. commercial stocks throughout the year, even with all of the SPR barrels being offered to the market, meaning much of this government-owned oil went to foreign buyers. If you look at the chart on the left, you can see how much the SPR has fallen below commercial inventories, even though the graph doesn't go back this far. This is the first time in 30 years that the SPR has fallen below commercial inventories. The risk is that if we experience a big supply shock, the buffer inventory in the SPR is at a very low level. And then speaking of exports in general, the chart on the right shows year-over-year exports. The orange line is the current year. You can see how much the US is exporting. We're actually exporting the greatest number of barrels ever, and last month it was around 5 million barrels per day. So even though our domestic oil production is higher, we're seeing a lot of that crude go abroad. Now let's move on to the next slide and talk about Russia. The main question right now is whether Russia will be able to find a home for its crude production or whether they'll have to curtail. When the Russian war began, European demand for Russian barrels fell significantly. However, Russia managed to keep its exports relatively unchanged due to increased demand from buyers in China and India. And the chart on the left shows this. You can see exports to Europe is the orange line, and exports to China and India are the purple line. And you could see how the two of those lines basically switched this year. On the right-hand side, you could see Russian liquids output, and it's been above the 5-year average for most of the year. And so you can see that they've been able to find a home for their liquids up until this point with renewed demand or with increased demand to China and India. Moving forward, it's uncertain whether Russia will be able to keep up with this level of exports now that the G7 implemented a price cap on Russian crude at $60 and the EU has banned imports. At the moment, we don't think the price cap will negatively impact Russia, considering $60 is around the current price they're getting for their Urals crude, taking into account the almost $20 negative basis of Urals versus Brent. However, the EU embargo will certainly play a role. Some agencies, such as the EIA, are estimating that Russia could end 2023 with 1.6 million barrels of lower output when compared to the fourth quarter of 22. Now let's move on to the next slide and we can discuss option skew in the crude market.
Hey, Mary, we just got a question come in that was on what you just touched on the price cap and whether or not a price cap of $60 would ultimately impact, Russia's ability would it curtail their production at all? And, you kind of touched on it, but I think it's a good time to kind of touch on it again is, differentials are $27 under Brent. And right now Brent's trading front month 76. So we're talking about Russia's fetching $50 a barrel for their crude on a spot basis, and the price cap is 60. So it's actually having a bit of the opposite effect at this point. So, as Mary said, not having any impact, and if anything, at current price set, it's helping Russia. So just wanted to throw that in there, but back to you, Mary.
Thank you, Austin. Yes, that's true. So right now, I mean, unless Brent sells off significantly and that basis widens, right now, Russia will still continue to make money producing its crude and exporting it. Okay, so back to skew. I want to highlight what's been going on with crude option skew over the past year in light of the Russia-Ukraine war. And I'm going to just touch on options 101 for a second. So a call or a put option is similar to insurance that you buy, and it will protect you from either prices rising in the case of a call option or prices falling in the case of a put option. And when we look at skew, in simple terms, skew compares the relative pricing of a call or put, meaning which one is more expensive than the other. When calls are more expensive, it means there's call skew and the market is concerned with upward price risk. And when puts are more expensive, there's put skew and the market is concerned with downward price risk. It's interesting to look at skew as it pertains to certain hedging structures, such as costless collars. So on a producer costless collar, typically that is when you buy the put and sell the call. And if there is put skew, which is what we've seen historically in the crude market, the put that you buy is $10 out of the money, but the call that you sell is only $7 out of the money. And that uneven relationship between the two is due to the put being more expensive than the call. And that's been the case historically in the crude market. However, when Russia-Ukraine war broke out, we saw call skew come back. And this is mainly because there was a lot of uncertainty of how high prices can go. So calls got very expensive. And you can see this change in skew by looking at the chart on the left. It shows skew for Brent options that are 6 months forward. So following the orange line, you can see how it went positive in March of 2022, meaning that call skew came back. And before that, the line was negative and there was put skew. And so during this time of put skew, producer collars looked extremely attractive, and that $10 out of the money put that you might have purchased would have yielded a $13 out of the money call. And so we saw many producers taking advantage of this opportunity and hedging with collars at the time. If you continue to follow the orange line through to today, you can see that put skew has returned, but there's still less of it than in previous years, and producer collars remain at attractive levels. On the right-hand side, there's a chart that shows current WTI producer pricing for the month of June 23. This is actually a snippet from the HedgePoint pricing tool that Jonathan mentioned earlier. And you could see how the tool graphs historical pricing and shows you the upper and lower strikes for this collar structure, along with the current market. So this is just an example of what our technology platform looks like. So for this specific producer collar, you can get a 70 put by 89.50 call in a market that was trading around $80 at the time. So the put is $10 out of the money, the call is $9.50 out of the money. So the put versus call is almost evenly spaced. So even though put skew has returned, it's still lower than in the past, and producer collars remain an attractive hedging strategy. I think that's it for my section. I'm going to pass it off to Austin, who will cover refining and midstream.
Thank you, Mary. Yeah, again, this is Austin. Going to go over kind of, the refining sector downstream, and then sum up everything here at the end, and then we'll open it up to Q&A. So if I can get the slide to work. So Mary touched on spare capacity in the US and globally around oil. And I think it's another topic to talk about spare capacity around refineries. Ultimately, ever since COVID caused a lot of economic shock and caused a lot of refineries to have to rethink whether or not they should exist, ultimately we saw a lot of refinery capacity shut down. There's been kind of two, roads to the shutdowns. It's been either due to poor economics, which in hindsight probably would have improved if we had foreseen the Russia invasion, or it was due to conversions to biodiesel, renewable diesel. And so you tend to see a shift of more of the West Coast refineries, or PAD 4, PAD 5 refineries like Cheyenne for HollyFrontier, or for Marathon Martinez in California. You see them shift to biodiesel conversion kits. And the reason for that is because the West Coast has a really big incentive with low carbon fuel standard, which is an additional credit in your pocket in addition to RINs for generating that fuel. So we've seen these closures, which has ultimately resulted in kind of a more difficult resupply situation for downstream products like diesel and gasoline. It's not just the US either though, because if you look at Europe over the last 10 years, there's been a bit of a structural shift in spare capacity or in refining capacity. So we've lost 1.3 million barrels of US capacity just in the last 3 years, with the biggest one being Pez, which I'm sure a lot of people saw in the news a few years ago, and they went bankrupt up in Pennsylvania. And so that was one of the biggest suppliers to the New York Harbor market, which ultimately just makes the the resupply and the pricing center that much more difficult to fill up. Kind of looking at utilization rates and where we're at today, even though we're sitting at some of the highest utilization rates in the last 5 years, we're utilizing those 96%, on a lower outright capacity. So you're not getting the same kind of refined fuel end product that you previously could 3 years ago, 4 years ago. Why are we producing as much as we are? Why are refineries running full bore? A lot of that just comes down to the price incentive. So cracks in the Gulf Coast, it's called 3-2-1 crack. It's essentially 3 units of crude to create 2 units of gasoline and 1 unit of diesel. So think of it as a complex refinery producing 66% gasoline and 33% diesel. We got up to around $60 a barrel on that crack over the last year. So really the Russia invasion of Ukraine sent price incentives through the roof for a lot of refineries to just figure out anything they could to run full steam ahead. And that's kind of what we're seeing with this utilization rate seasonally at the 5-year high end of the range right now. Looking at another thing that, within the refinery walls that refineries can kind of tweak, and something that's good to keep an eye on in terms of if you have interest in gasoline or diesel, is the ability to switch your yield slate, the ability to switch from gasoline to diesel and vice versa. So within the refinery, there's a couple ways that you can produce more of one product. There's things called kind of a cut point, where there's some shifting within the actual, within the refinery itself. And then there's also crude slate differences. So, taking heavier crudes will produce more middle distillates like diesel, jet fuel, fuel oil, whereas taking lighter crudes like the West Texas, light crude kind of lighter slate is going to produce more gasoline and some of those high-end products. And so if we look at what's happened, gas versus diesel has traded as low as a negative 100 cents per gallon, meaning that a refinery's incentive was 100 cents greater per gallon to produce as much diesel as possible in lieu of gasoline. And so what we've seen kind of, structurally, is that we've seen diesel yields rise. You can see from a little under 30% to around 31%, while gasoline yields at their highs have dropped from 65 to 70% down to around 57% now. And so the reason this is important is as we start to rally back here, and as gas versus diesel spreads start to get back to parity, still a long way to go. But if we do start seeing that again, then refineries will have an incentive to kind of reverse course. And if they reverse course, then going into the winter, if that happens, then all of a sudden you have an incremental bullish scenario for the distillate balance, because less diesel is being created in lieu of creating gasoline. Another aspect to the recent kind of collapse in fuel prices and diesel gasoline particularly, and just the crack spread that we just saw in the previous graph, is back in September, there was an announcement from China that they were going to try to match a 15 million metric ton export quota by the end of the year. And to put that in perspective, that's close to 110 million barrels of clean products that are going to be exported to places like Singapore, Europe, and if the incentive is there to the US. And so I think on this day when that news came out, you can see the crack spread in Singapore, you can see it just absolutely collapsed. We went from $50 a barrel down to $20 a barrel on that news. And the reason for that is the anticipation of Singapore just getting dumped on by China. China starts ramping up crude imports, they refine more, and then they send those clean products to the closest bidder. And so in reality, what we've started to see, you can look on the left chart, the dotted line is what the exports would have to be to actually hit this level of refined product export quota. And the solid line at the end of November is clearly nowhere near that 2 million barrels a day that we need. It's about half of that. So when the November data comes out at the end of probably at the end of the December, we'll have a better idea of if China is actually even coming anywhere close to this export quota. And if they're not, then I do think there's a little bit of a whiplash risk, because the market is very much kind of believing in the East imports, and the recent $1 a gallon downside in diesel seems to believe it as well. As a OTC shop and as a hedge counterparty to our customers, it's goes without saying, it's a subtle plug to kind of mention what we can do here for refineries. So we offer flexibility with crack spreads. If you need to hedge regional crack spreads, you're in the Gulf Coast, we have basis swap liquidity. We can also hedge a specific ratio. So if you need a 3-2-1 or a 2-1-1 crack spread, depending on your kind of refinery output of individual fuels, we can kind of lay that up for you and make that more particular. The other thing worth mentioning is, over the years, we've grown a pretty decent customer base in the renewable diesel and biodiesel space. And ultimately, that comes with new products that have to be developed to kind of meet those needs. And so the most typical hedge is kind of looking at heating oil versus bean oil, called the HOBO. Also GOBO if you're in Europe, ICE gas oil versus bean oil. And then even looking at, stuff versus palm oil for some of the European players. And then lastly, in 2023, one of our big product pushes that we've had demand for is to have intercommodity spread options. So, things like cracks, where you can have an option as a refinery to protect the downside on a crack without actually having to go and sell that, that margin. And then lastly, financial RVO and RIN swaps. So part of the volatility in the crack that I didn't mention in the previous slide is that RVO plays a huge part when you adjust your refinery margin for the cost of the EPA's mandate. And so that cost is around 20 cents a gallon, which is about $8 a barrel. And so when you look at a 3-2-1 Gulf Coast crack of now 20-25, and you take off 8 of that, it's actually not so high as the graph might entail. And so hedging some of that downside risk is something that we can help with. Moving into downstream, so we talked about macro, upstream, and now we're refining the crude, but ultimately, what are the end products, and what's kind of the state of the union, as I say, for the Atlantic Basin right now in terms of inventories? So the AB, Atlantic Basin, is, just think of it as kind of which two sides of the world can solve each other the easiest. So Europe can export to the US and US can export to Europe. So the Atlantic Basin, by the Atlantic Ocean, that's kind of what we're looking at here, and we think is kind of the most relevant, because a lot of times that's kind of how you solve New York Harbor and how Europe gets solved from the Gulf Coast. And so looking at ARA diesel and US diesel for a second, it's very clear that we're in a pretty tight inventory situation on diesel. We're below the 5-year average for both regions. We're kind of rallying back a little bit here on inventory in the US, which I'll touch on a little later, but we're still in pretty dire dire inventory situations compared to previous years. So we think going into the winter here, it's definitely something we got to keep an eye on, and it just creates more potential volatility. Now, focusing on gasoline for a second, I think if you're looking at U.S. gasoline balances just through a lens, you might look at that chart and say, why is gasoline down as much as it is? Why are spreads collapsing? Why is the price not being able to really catch a bid? And I think when you kind of look at the AB as a whole, that tells a better story, because if you look at Europe, it's not even close to as similar as the U.S. diesel situation with ARA. They're both in very dire situations, whereas for gasoline, Europe still has a lot of inventory to ship. So if we need to import into New York Harbor in the winter, which is a pretty standard move, gasoline, Europe has that volume to give. And traditionally the ARA or Europe is a consumer of diesel. Their cars, their businesses, most of it runs on diesel. So they typically are an exporter of gasoline, whereas we are an exporter of diesel. Another big reason for why we've been so tight, and this is kind of similar to what Mary showed on crude exports, is refined fuel exports are at all-time highs. So we're exporting 6.3 million barrels a day on the most recent stat, but we've gotten as high as close to 7 million barrels a day if you look at kind of your end products like jet, diesel, gasoline, et cetera. And so why that's important is, if we're exporting this much, you might ask why, like, if inventories are this tight, why are we exporting this much? And so I think part of that can be solved through basis and through, different price incentives in different parts of the world, which I'll touch on in the next slide. But just more intuitively, looking at the right graph, when you think about kind of all the headlines we get around core inflation and then CPI and, energy CPI, ultimately there's a pretty strong inverse correlation between, CPI and gasoline and diesel inventories, which, it does make sense. If gasoline and diesel inventories are trending lower, then CPI is going to trend higher. And so I think sometimes there's a lot of focus from, the administration and just in general, the public eye focusing on crude SPR releases and wondering why are gasoline prices not falling? Why are diesel prices not following? But if you look at the actual situation in those clean product markets, it's very different than the crude market. And the SPR, you ultimately release crude to refine it. And as we saw in the previous slides, there's not a lot of spare capacity to refine. Thus, downstream product markets are going to remain tight. So kind of just summarizing that, that export chart and why that's happening. Again, you might look and say, why are we exporting so much if we need the diesel and we need the gasoline? And I think the question can be found, or the answer can be found in basis. And so basis is basically just described as the regional price set versus whatever the local, NYMEX or ICE screen that you're looking at. So for Singapore, it's looking at ICE gas oil. For ARA or Europe, it's looking at ICE gas oil as well. And then for the last two in the US, we're looking at NYMEX heating oil. And so if you look at the basis, I really wanted to point out, ARA in New York, but we had some very extreme basis spikes in New York Harbor where we were seeing 70 cents to $1 a gallon over the NYMEX. And so the Gulf Coast on the flip side, this graph is just looking at the month average. It was minus 17.7 cents per gallon, but we got as low on a kind of a prompt basis as minus 35 cents a gallon in the Gulf Coast for diesel. And so if you're looking at that and you're an exporter or a trader, like the Traffies of the world, the Vitals, the BPs, you're going to look at that and try to figure out how you can make money. And so the reason that we're not keeping those barrels at home is because the price incentive is telling everyone to get rid of them and send them to other places that are willing to pay a lot more. And so you look at the basis charts, and it's very clear that the ARA, New York Harbor, some of these other regions were paying much more. And LATAM is another big export, location for Gulf Coast diesel. The other kind of thing about this is, since then, Colonial Pipeline is kind of the biggest transfer ability to move diesel from the Gulf Coast to Pad 1 or New York Harbor. And so part of the reason that New York is very spikeable and why the Gulf Coast has not been able to catch up is because Colonial Pipeline is fully allocated, meaning there's no room, there's no additional spare capacity in the pipeline to send additional volumes up there. And so when that happens, really your only other outlet for that fuel outside of going to Latin America or to ARA is to maybe Jones Act it up. You need a US flag ship to get fuel from the Gulf Coast to New York, and the price incentive could be there. The problem is there's no way to get your hands on those ships. There's just no supply of Jones Acts available, and they cost quite a bit more. So, there's been a lot of push in the industry to waive that, that ban on only using Jones Act vessels and allowing foreign flag vessels, because it would have been a no-brainer for us to just send fuel to New York. And then kind of moving into the Northeast that we're talking about here, and those tight diesel inventories. When you look at just pad one is 50% below 5-year average inventories. So, to put that in perspective, we're typically, well, to put it in perspective, we're typically on par with the average. We're 50% below, and we were 60% below last week. Meanwhile, pad 3 is actually 9% above 5-year averages. So it kind of all, ties into the basis charts we were just showing, and why you're seeing these massive differentials in different regions. Another thing that, as we were making this webinar, this recent spike was not here, but, imports have been a big thing that we have not had until really just this past week. So we've been looking at really kind of the anticipation of more diesel imports as a way to solve the New York harbor market, because up until now, we've only had 90 barrels a day 90 KBD of diesel inventories on imports. And then most recently this week, we spiked to over 300 KBD. And so just last week's stat, I think we saw about a 200 KBD increase, which is, thousands of barrels per day. So over 7 days, that's 1.4 million barrels of diesel that hit the pad 1 or New York area just in 1 week. So, tying all that together, we wanted to look at the front spread and just heating oil backwardation in the market to kind of make sense of the fundamentals going on, because, as the pricing center is in kind of the Northeast and that New York area, then ultimately all of this tightness and all of the lack of imports that we just talked about are going to incentivize price to the upside. And so what we saw was, 1 month versus 12-month heating oil got to as high as $1.50 a gallon. So at that time, we're talking about if you were to go and roll your inventory from now until 1 year from now, you'd be paying 150 cents per gallon to do that. And so the reason this is important is because really any person in this industry, except the very, very end consumer with no tank or storage space, your producers have storage, your refineries have storage, your wholesalers have storage. Everyone has storage capacity, and everyone that's holding physical inventory, whether it's crude, whether it's diesel, whether it's gasoline, they have to sell futures against it typically if they want to remain hedged. And so when you sell that front month heating oil future against your physical inventory, when that month comes due, you ultimately, if you have any inventory that needs to stay in that tank, let's say you have 50,000 barrels that you need to roll to the next month, then you have to go buy the front spread. So, if January right now is the front trading month and you are getting to the end of December, then you're going to go buy January, February heating oil spreads. And so the graph on the right is basically showing what has happened in some of the major blowouts just in the past 12 months in terms of how steep that backwardation got, and effectively how much it cost one of these players to have to roll their inventory. And so, recently we've come off quite a bit, but even as early as last month, we saw, this front spread get up to 80 cents a gallon. So if you're running a business and all of a sudden you have to roll your inventory at 80 cents a gallon, on a 2-day notice, it's going to eat into your margins. I mean, you're not sitting on $1 a gallon margins in most of the businesses out there. And so 80 cents is something that really can put a dent in your business. And so, it brings me to my last point here. Hedge Point, ultimately, again, bilateral hedge counterparty. So we look at ways that we can help our customers hedge these kinds of risks. And one of the things that we saw a lot of demand for in, over the last kind of 2 years, 3 years, if you include COVID, was an ability to hedge that front spread risk. And I think the real reason that people don't necessarily want to just roll their spreads is because if the front spread is at 80 cents per gallon and you go just lock that in, you've effectively locked in your margin loss. Whereas if you're able to use some type of insurance or option like this right here, then you have the right, but not necessarily the obligation to roll your spreads at that level. And so kind of just simplifying it here, Jan Feb heating oil, if it was trading at around 5 cents per gallon, you bought a 10 cent per gallon call option and you paid a 5 cent per gallon premium for that call option, then ultimately your break even's at 15 cents. And anything above that, if we get to the end of the month and you're rolling your inventory and all of a sudden spreads blow out to $1 a gallon like they did a couple months ago, then you're not on the hook for any of the money above 15 cents per gallon. You paid that insurance, you're protected, and then we can financially settle that or actually roll your spreads for you and keep that inventory hedged in the following month. So kind of just to summarize here, everything we've talked about, I think ultimately there's a lot of kind of equal weighted factors going on right now, because if you asked us 3 months ago, I think a lot of people were very very bullish, and as time has gone on and some of the stuff Jonathan touched on and Mary touched on around China demand being lackluster, COVID, stringency, all of this stuff, there's starting to become some equal weighted risk on both sides of the aisle. And so just kind of highlighting, bullish risks are a lack of CapEx driven by higher rates and just higher funding costs for projects, refinery closures and, biodiesel, renewable diesel conversions, taking away some of the traditional, hydrocarbons to the market, strong economic activity despite recession fears. So, despite all of the talk of a recession, jobs numbers, jobless claims, wage data, all of that is coming in very strong, PMIs. So I think as that data comes in, ultimately as an industrial economy that consumes diesel, for example, if that data is coming in strong, then you're going to continue to see a decent demand for some of those fuels. And then lastly, tight global inventories across crude and products. Anytime there's tight inventory, it just sets yourself up for more volatility. On the bearish side, we have a rising rate environment, a hawkish Fed, China COVID lockdowns, which we touched on earlier. And then one that's maybe not so likely, but something we always have to keep an eye on is potential relationship improvements with Russia, because, even though we might not publicly go out and say we're friends with Russia, there are sometimes, political maneuverings that you have that look like you're against them, and ultimately it really has no impact on them. Kind of case in point, the price cap right now, there's really no price incentive curtailing Russian oil at that $60 price cap, but on paper it looks great to the market. And then lastly, OPEC plus supply changes. I think, as Mary mentioned, we're on a very tight spare capacity. The only real players that have any oil to give at this point are Iran, Saudi, and UAE. And the first one is kind of, ultimately you need to see some type of nuclear deal, which it seems very unlikely. If we were going to get one, it was probably when we were at $120 a barrel, not when we're at 70. And then Saudi always has the ability to kind of, come back into the market and change things up. So with all that said, just wanted to throw out our disclaimer. So read that quickly, and then open it up to questions, which I think we've been getting questions throughout the presentation here. So
there's a couple on there, but I think we can sort of roundtable it a little bit. There was one that I noticed, if you want to take a drink of water, Austin, was right before COVID hit, Russia and the Saudis were fighting for market share. Now it's all about OPEC plus. Do you see the EU embargo and or Iran's persistence, that's a funny way to put it, good way to put it, impacting Russia, Saudi's ability to work together? I mean, in short, yes, of course. I mean, we're seeing this is a new global order that is coming about here. We're seeing new frictions, new volatility, and as I mentioned earlier, these are generational shifts in energy markets that we are going through, and this is going to take quite a long time to sort everything out. The Saudis, from their perspective, they want to show independence from the U.S. Clearly, they've clearly shown that, especially someone like Joe Biden, who's tried pretty hard to sort of heal the differences in there, but they do not want to be shown to be kowtowing or doing the U.S.'s bidding. They're making that clear. But at the same time, they're walking a careful line, as is most of the sort of quote unquote non-committed world. You could even throw someone like China or India in there. They clearly don't want to be shown to be doing what the U.S. wants them to do, but also don't want to go so far as to be doing the opposite of what sort of the Western world wants to be done. So it's a very careful sort of line that a lot of these countries are walking right now, especially in terms of producers like Saudi Arabia. The Saudis want crude above $90. From our perspective, that is high, but not alarmingly end of the world too high. If you look back, say 15 years ago, in terms of dollar inflation, that's like $62 crude oil from say 15 years ago. So it's high, but it's high enough to, as the Saudis would say, encourage more investment in productive assets. So I think a lot of the war, it's Iran, it's you don't want to tread lightly and say it's distractions from that goal, but really the Saudis, all they really want is crude oil at and above $90. So yes, it is impacting the ability of the Russians and the Saudis to cooperate. And yes, it is adding more variables and more volatility to the supply equation, but that is just simply the world that we're living in now going forward. It's going to be more complicated and more volatile and only going to continue in that direction, most likely.
Yeah, it looks like we have one that is somewhat relevant today, probably today only. Question on Keystone Pipeline. There was an outage today, and just asking whether or not, the market seems to be shrugging it off. So I'm happy to take that one. Yeah, I mean, everything that we've read today is that, Keystone Pipeline, 600,000 barrels a day from Canada to the Gulf Coast and Midwest. We saw Cushing rally early morning, spreads were bid, but ultimately faded, within a few hours. The outage happened around 10 p.m. last night, as far as my understanding, and most of the trade and the street are kind of saying that it's a non-event because they're going to be restarting today. So that is something to keep an eye on, though. The market's faded it, but if for whatever reason there's issues bringing it back, then of course there's upside risk to crude and to spreads there. Let's see what else here.
There was a good one about just simply, I think it was peak. Is this peak gasoline demand in the US? I mean, sort of trying to predict the future on that one, but my thought is no. The grid is not ready. And when I say the grid, in terms of electric cars, when I say the grid is not ready, I mean the grid anywhere. Places like somewhere like Switzerland, which is very first world in terms of their technology, in terms of their infrastructure, already trying to pass laws limiting the use of electric vehicles. We've seen over the past 2 years, California limits the time when you can charge your car. Certain nights you can charge it, certain nights you can't, because there simply isn't enough electricity. The grid cannot handle the demand for the very small amount of electric cars that we already have. You also have to ask the question of how is that electricity produced? You're driving around in a Tesla, it doesn't mean that you're actually saving the world, because you still have to burn something. You have to create that electricity somewhere. You have to burn something somewhere. We are a long way from replacing natural gas, coal-fired plants with solar and wind enough to really have the enough power, and we don't have the batteries either to be able to store it. So it's a nice idea, but I still think we are a long way away from peak gasoline demand, to be honest.
Yeah, and I think you touched on something I was just kind of going to jump in on. I mean, I think it's funny, we ultimately the whole world wants to reduce greenhouse gas emissions, and everyone's kind of like-minded on that final end goal, but you then see all of these kind of one-off policies come about out of nowhere. The windfall tax, for example, that was supposed to be on hydrocarbon and on electricity, power, et cetera. Ultimately now in Europe, they're putting that price cap on or that windfall tax on renewable sources as well. And so all these projects that have this massive incentive to put wind into solar and renewable diesel and all these things to go online, they're all driven by the economic incentives from the government most of the time. And so if there's a shift or a regime shift in terms of those political incentives, then those margins become very tough. And I think, kind of case in point, the EPA announcement last week was a huge upset for the RD, the renewable and biodiesel industry, unfortunately, because the USDA had pinpointed around almost 11 billion pounds of soybean oil was going to be demanded by energy takers, namely for renewable and biodiesel. And ultimately, the change in the EPA's RVO, the renewable volume obligation, from 2022 to 2024 is almost nothing. And so the amount of capacity that is planned to come online and the amount of investment that's gone into creating new RD plant capacities, BD plant capacities, is extremely substantial compared to the demand increase that the EPA just granted. And to make matters even worse, they are now allowing EVs to generate a RIN. And so there's going to be these things called eRINs, which will generate from electric vehicle, albeit those electric vehicles have to be powered by some type of biogas at a plant level. But ultimately, all of this means is more supply of RINs on the market, which displaces your food feedstocks. And so I think that was just a big shock last week. And if anyone follows the soybean oil market that's on here, we've dropped from 70 cents a pound all the way to 60 cents a pound in a matter of 3 days. So if you thought energy was volatile, that's pretty substantial.
What else? Austin, before we run out of time, there was one here that I saw about someone had said about us mentioning our technology offering. Can you elaborate? Do you want to touch on that for a minute?
Yeah, sure. Yeah, so you touched on it a little bit at the beginning, but ultimately, I think as part of this new transition to HedgePoint a couple years ago, a lot of capital and attention is put on creating technology for our customers. And so there's things, just simple things like in the past, onboarding people over emails. We now have an online portal hooked up with DocuSign to help usher the onboarding process along. Our most recent rollout is our client portal that's all Chrome based. So you just go onto Google, put in the link, you have an online a login, and then you can actually price your own structured products, your own derivatives with real-time volatilities from our trading desk. So that's something that we're super happy about, and it allows our customers to kind of come in and price things themselves, and it puts a nice little chart up there, which Mary actually kind of showed earlier. And you can actually share that quote internally if you have to sell it to your C-suite first, or you want to share it to somebody else internally, or if you just want to share it to us and get our thoughts. It comes along with a price reference, the date, the timestamp, all that. And then lastly, the most recent thing we launched was, traditionally we had PDF statements, so you see all of your positions in a PDF format. But now we've rolled out our position control, which is an online Power BI based tool that really takes your entire position and breaks it down into the nitty gritty with graphs and visualizations and just concise data that is completely filterable. So, those are some of the things that we're trying to do, and I think it's just the beginning.
There was also a question non-market related, whether we would be able to share this, the PowerPoint that we discussed after the call, and we will be doing that along with a recording.
Very cool. There's also always a fun one question. I love this question. Are you guys bullish or bearish energy in general? I hope you guys have a couple hours, because we could just sit around here and argue about this for the next couple hours. But my 2-second elevator pitch on this is that I think the sell-off we've been seeing, honestly, is part of just a larger asset sell-off. You're seeing it across commodities, across equities. I think it's sort of, there's plenty of reasons. You could always find a reason. If we rallied $3 tomorrow on no new news, somebody would come up with something somewhere about, oh, it's risk on again. So there's always going to be, there's always noise out there. But I think a lot of what we're seeing is just a general asset sell-off in terms of worries about economic activity in the near future. My perspective is there's too many worrying variables out there. I think we've fallen too far too fast. I think momentum indicators are oversold. The market has just moved too much, too quickly. And I think if you're worried about another 15 to 20% move, I think there's a lot more risk of it being on the upside than on the downside at this point. And to reiterate, in the more of a longer term, a point that I made earlier at the beginning, that in terms of global crude oil demand, just getting up to a couple million barrels per day above where we are right now. It had dipped down to the mid 90s in 2021 as a result of COVID. It's back up closer to the high 90s now, but just to get up to 102 million barrels per day by 2030, that gap, you're going to need another 25 million barrels per day because of other production going offline. So there's a lot more worries to the upside. We're at the point now where I think if we dropped another 30%, it would be because there's a lot of major problems in the world, right, in terms of economic issues that have surprised us. Whereas I think it'd be very easy for Brent or WTI to rally another $15 or $20 without anything too new sort of propelling us back up there.
Yeah, yeah, and I think there was a question here on the February Russian product ban in the market. Question says consensus is that Pad 3 can help solve that. What are our thoughts? And yeah, I think it's probably good to get a quick refresher because the December 5th, which effectively is in effect crude oil embargo on Russian oil, it's already in place. The price action wouldn't really make you think that, but it has started along with the price cap. But one thing that maybe is not as widely known is that the clean products like diesel, gasoline ban is not until February. So a lot of people have kind of been looping them both into the same December 5th date. But at the end of the day, ultimately it's both clean products 2 months later. And so to answer the question, I mean, it's a good one. I think Pad 3 definitely has room to export and solve some of the other world's problems. With that said, Pad 3 basis has rallied from the lows quite a bit. We were down as low as, on diesel at least, as low as 35 cents under the screen, and now we're in the teens. So we still have a long way to go, but we're starting to clear out some of that inventory on these massive exports. And so if all of a sudden we get to February and Russia cuts off that that diesel and gasoline, it definitely could put a dent into the winter. And I think just really what we got to be careful of is anything in the winter is kind of has the spikeability risk when you're sitting on this kind of low inventory. So I think just gotta stay hedged and stay vigilant on what could happen there with if that happens.
Agreed. Okay. At this point, did you see anything else? I think I'm probably going to wrap it up. I'd like to thank everybody at this stage for joining. I want to thank Mary and Austin. Thanks for the presentations, and thanks for the good questions, guys. I think all right. Everybody have a happy holiday and enjoy the time off, and looking forward to a very exciting and certainly interesting 2023 as we go forward here. Thank you.
Thanks, everyone.
Thank you, everybody.